In this short video, I'll be going through some of the questions or problems that you have in Connect with the data altered, and some of the questions I'll be going through were not assigned, but will help make more clear some of the concepts that were discussed in Chapter 12. First one we'll look at is multiple choice question number 27. That's found on page 1227, one of your Connect problems. Here, Ava is exchanging land used in her business with Gail for another parcel of land. The basis of Ava's old land is $50,000. They change it to $51,000. Fair market value of $66,000, and she also gives Gail $14,000 cash. So that's boot, but she's paying the boot in this case. So that will not trigger our gain recognition since she is paying the boot. However, it will add to her basis. So Ava's adjusted basis is just the $51,000 using my numbers, plus the boot that she paid to Gail, the other party. So her basis is $65,000 using my numbers. And feel free to replay these as often as necessary to make them more clear, if need be. Now we'll move down to question number 30, another Connect assigned question where I've altered the data. Gretel exchanges a warehouse with an adjusted basis of, in my case, $149,000, fair market value of $160,000 for a mini storage building with a fair market value of $100,000, and she also received $61,000 in cash. That's boot. So since she's receiving the boot, in this case, that does trigger the recognition of gain. So one of the first things I calculated then is, what is that gain recognition? And the gain recognition then will be the minimum of the gain on the transaction and the boot received. So we're going to compare $61,000 to the difference between $149,000 and $160,000. And the lesser of the two then is $11,000. So she will be taxed on $11,000. Again, the lesser of the gain or the boot received. In this case, the gain is less. The difference between $160,000 and $149,000 is only $11,000. Again, we'll compare that to the boot she received of $61,000. We'll take the lesser of the two. $160,000 minus $49,000 is $11,000. That's less than $61,000, of course. So she will be taxed on $11,000 of her gain, the gain. And then the adjusted basis of the mini storage building she acquired will be equal to the adjusted basis of the warehouse less the boot she received plus the recognized gain. So in this case, we'll take the $149,000 and we'll deduct the boot that she received, and then we'll add to that the gain she recognized, the $11,000. And this is consistent with the formula in the text. So her adjusted basis in the mini storage building she acquired is therefore $99,000 using my numbers. Jumping down to number 41, which was is listed in the text on page 12-30, another Connect assigned problem. Number 41 then, where Daniel is single, purchased a house on May 15th, 1995 for $115,000. During the years he owned the house, he installed a swimming pool at a cost of $24,000 and replaced the driveway at a cost of $12,000. On April 28th, Daniel sold the house for $470,000. He paid a realtor commission of $28,000, legal fees of $1,000 on the sale of the home. What is Daniel's recognized gain on the sale? Okay, so in this case, as we look at the data, we have the purchase price of $115,000, and then we're going to add to the basis the cost of the pool and the driveway. So we're building up the basis then for Daniel. Sale price of the home I changed to $472,000, and from that $472,000 we're going to deduct the $28,000 sales commission and legal fees. So what we're trying to do then is we're trying to calculate the gain and then compare that to the exclusion amount of $250,000. Well, I broke it out a little bit here. I said the adjusted basis of the house at the time of the sale is going to be, as I said earlier, the $115,000 plus the cost of the pool of $24,000 plus the cost to replace the driveway of $12,000. That builds up the basis to $151,000. So the realized gain on the sale of the house then, the realized gain, not the recognized, but the realized gain, will be the sale price of $472,000, and we'll deduct the 28 sales commission, deduct the 1,000 legal fees, and then we'll deduct the adjusted basis of $151,000, and that will give then $42,000 as recognized gain on the sale of the house, because the $292,000 exceeds the exclusion amount of $250,000 by $42,000. So there's a partial gain recognition on the sale of this house. Number 43 on page 1230 is a case where Nigel sells land with a basis of $55,000 to his son Ted for $40,000. The land's fair market value at the date of the sale. And now the question is, and the $40,000 is the fair market, and he paid $55,000. So there's a potential $15,000 loss. So if we assume that Ted sells the land for $55,000, the question is how much of the gain is recognized. Because this is a related party transaction, the gain realized when the related party subsequently sells the land sold to an unrelated party. What's going on here then is that loss that was originally incurred between the related parties, it cannot be recognized because they're related parties. However, when it's time then for Ted to sell the land to an independent or unrelated third party, then the amount of the gain, 58 minus the 40, is reduced by the amount of the loss. Okay, so we have in this case, we have the $58,000 sale price minus the sale price on the land of $40,000, and so that is $18,000. 58 minus $40,000 is the $18,000, and then they get credit for that loss of $15,000. So now that loss we are able to take advantage of that loss that we couldn't take before because they were related. Now the loss comes into play, and then therefore reduces the gain from $18,000, which is 58 minus the 40, by the $15,000 loss that was essentially suspended. And so 18 minus 15 is the $3,000, and that's the gain that will have to be recognized. Jumping down to number 52. Number 52 is an example of a case where we had an involuntary conversion, and I will be going through this one in the next video.